Okay, I want to talk about this RealPage because the man Carl Whitaker put out another really interesting piece that kind of he's got a really good pulse on what's going on in the multifamily market, and I don't know. I think he's been hinting at something that you don't want to miss. The market in 2025. And so this is a piece on apartment rent growth expectations at the market level for 2025. So we're getting away from national rent growth, which it's an interesting metric. I think, again, it can summarize generally how like the business is doing, but every market and submarket is so different. I mean, we're looking at this deal right now that and literally, across the river, it's a completely different market. Yep. And the rent growth is different. The jobs are slightly different. Just different demographic dynamics, and so you have to be specific.
Well, and that's one of the things that I remember talking about a few weeks ago was 2025 may be a period in which the divergence among markets increases before it comes back together. Yeah. They may snap back in 2026 when supply becomes in a greater balance, but there's still some runway in terms of like how far apart these are, the ones with huge supply and the ones with very little.
I really like this, the way he's got it. 2025 performance expectations based on market profiles, and then a little color-coded system. I don't like about it is I'm kind of colorblind, so it's hard to see. But a lot of, so like the fuchsia would be, is that number one? Is that pink? Fuchsia?
No, but fuchsia is number 6 actually.
Okay, so how about Matt? How about you take us through the color guide?
All right, so we've got we got the first group, and actually I have.
Is that pink? Is that gray? What is number one?
No, that is actually a bluish tealish kind of green. God. I know we've got a red green situation here. I actually think that other than the color code, if you scroll down,
difference in the colors.
If you scroll down to their naming, it's actually a little bit more. I think it's pretty interesting how he comes up with this grouping here. So there is minimal to modest supply pressure and stable demand. And that's where I was like, Midwest, anyone? And we'll have the markets listed here. Gateway adjacent. Second is gateway adjacent markets where occupancy supports historically normal rent growth. Places like San Francisco and Seattle. I think those are perfect examples. Markets with the third one, markets with little supply but demand headwinds curb rent growth. I think there's a little bit of Rust Belt in here, a little bit of Midwest,
Cleveland, St. Louis,
totally. And then there is Sun Belt markets that are at or even slightly past peak supply, which is like
Orlando,
Miami, Miami, Tampa, Dallas, Houston, these markets that have and will power through supply, the ones that like we never really counted out during the pandemic at all, and they just powered through everything. They'll recover probably the quickest. On the other hand, you have markets where weaker than expected demand has challenged fundamentals, which is it's a little bit all over. It's like LA, Minneapolis, Portland. It's hard for me to get a real trend on the larger, for me to get a read on these trends of these markets. Minneapolis, I think they had put some efforts into expanding housing supply, maybe even before the pandemic. I don't have a source for that, but like I know that was a initiative that they had, that this was like they wanted to get housing prices under control. LA seems like its own animal, and just because of how big it is, even discounting the fires that have recently happened.
So they have to redo it.
And then I don't know. I always grouped Portland with other Pacific Northwest markets like San Francisco and Seattle. But I'm not saying that this is wrong. What I am saying is like I've got to go to CoStar and my data sources and look up the supply story for all of these, because I'm sure they're super interesting, and it's something that we even talked about on the Gray Report, especially like Seattle, where before the pandemic I think they built a whole lot, and then they built so much that rent growth during the pandemic wasn't even that strong, never really was as strong. Same thing, for a different reason. Rent growth was not so strong in San Francisco ever, because it was already so high. And then finally, it's these markets where supply pressure carries into 2025, potentially into 2026. Here's where you get your Phoenixes, your Charlottes, your Austins, your Raleigh-Durhams. These are the markets that Jay Parsons doesn't want you to use as examples of the Sun Belt, but they are all in the Sun Belt.
They actually make the little smile right there.
That's right.
Just draw.
It's kind of belt along the sunny states. Yeah. They are not the one-to-one example of all Sunbelt states. Like there are some real juggernauts in the Sunbelt that will continue, and we just saw how the employment and population figures of these Sunbelt states are roaring. But there are places that just have built so much, it's just gonna be harder to dig out of them.
Yeah. And so, just specifically, I mean, the markets with minimal to modest supply pressure and stable demand: Chicago, Cincinnati, Indianapolis, Kansas City, Pittsburgh, Richmond, and Virginia Beach.
Yeah.
These are all solid markets.
Slow and steady. What I think that slow and steady doesn't capture, though, is the fact that when there is an elevation, when there is like huge activity, whether it's rent growth or building, these slow and steady markets, they'll pick up things. They're not perfectly slow and steady. They're just a little less active, a little bit less volatile than the other markets. And if anything, it was to the upside probably, where some of the markets, they're seeing lower rent growth, and now we're just slow and steady. But it's more predictable. I think that's helpful from an investment standpoint. However, maybe you want more risk.
Yeah. Yeah.
But not me. Not right now.
Yeah. Yeah. Not. Yeah. I again, our whole thesis is largely based on a lot of this, and this is why we've been investing in Indianapolis and in similar Midwestern.
Because I was remembering the Berkadia research from Nate Stone and Jonathan Rappa. Again, the golden age of Berkadia research. They were talking about, like, what was it, beta, the how like different kind of volatility in Phoenix could be to the upside, but like at any given moment it could slip down, but over time you'll be on the upside.
Yeah,
you just have
low beta markets.
But there are real swings that you're gonna have to deal with in the meantime. So I don't like the idea of timing that, and like we don't know enough as much about those markets specifically, but like it does seem like timing is such a huge thing. You have to have the power and the money and the resources to either get out quickly or to wait it out.
Well, that's a really good description. I mean, the key to success in those volatile markets is it can be timing, because if you join the party at the wrong time at the end, and you have a shorter term business plan, because you're trying to capture all that growth and move on to the next one, and it kind of goes hand in hand with a more aggressive strategy.
And if you live there and the developers, and you kind of have been keeping an eye on how things are going and then it could be really great for you, but not, from an outsider's perspective, it's a little more difficult.
Well, and it's frustrating because you could have picked the right market, right submarket. It just, the timing might have been off a little bit.
Yeah, yeah.
And there was demand, but then all of a sudden everyone had the same idea that you had around the same time, and then not just what your apartment was delivered, 200 units. You've got thousands of units in the same submarket that are all competing at the same time that you didn't have a great job of anticipating. And so, over time, it'll all work out, but you're on a 2-year bridge loan. So you don't have time. So give yourself time and go in a market where those time squeezes just don't present themselves as often, and you can just let the asset grow and make really good returns over time. So, gateway, we don't have to list all these, but, in their second category, gateway adjacent markets, that'd be like Boston, Inland Empire, Newark, New Jersey, Orange County near Anaheim, San Francisco, Seattle, and Washington, D.C. The markets with little supply but demand headwinds curb rent growth: Baltimore, Cleveland, Greensboro, Winston-Salem, Memphis, Milwaukee, Philadelphia, Sacramento, and St. Louis. And then Sunbelt markets at or even slightly past peak supply would be like a Dallas, a Houston, a Vegas, Orlando, Salt Lake City, South Florida, Tampa. It's interesting. I feel like the collection, these are interesting groupings, and because like I'm just thinking of different like sponsors and investors I know, and like literally like sometimes it seems like it can be like an eclectic mix of markets, but I'm like, I know an investor that does like those are the markets that they invest in.
Yeah.
Similar to like at the top I'm like, yeah, these all look familiar. These are all markets that like I am invested in or considered or considering. Like Virginia Beach, I've always liked the Virginia Beach market. It's a little bit out of our like geographic expertise. Kansas City, always really like. It's similar to Indianapolis, which is our headquarters. Pittsburgh, it might as well be a Midwestern city. It's Western PA.
Yep.
In Richmond, I'm not as familiar with, but like I'm like this list, I'm like, yeah, I could get down with that list.
Yeah.
But then I go to this, I'm like, these are like institutions that I don't know. Like I know people who focus on these markets, but I'm like, it's just a different food group.
Yeah.
To me, it's just, I don't know how to operate in those markets. Boston's, there's just huge firms, a lot of more institutional capital, DC,
Interesting.
foreign investments.
That's interesting how these are lining up from your perspective as from the acquisitions perspective and the players and how it lines up with the performance. Yeah, for sure.
Because it's like, I'll talk to someone you think that, you talk to a ton of investors in the Sun Belt, and that makes sense. But then you start having conversations with these guys who are like, we only invest in like the gateway markets, like the LAs, the Bostons, the New Yorks. Like, oh, okay, that's totally different from what we do.
Yeah.
But it's not. But the markets just seem, they have a different profile.
Yeah.
And it's hard to like readjust again, even though it's the same thing, like the process of buying and operating the multifamily property. Obviously, the rules and regulations can be very different.
Yeah.
But it's like I would really never consider doing a deal in Boston or I mean, New York's a whole other story. But again, like I'm reading this list, I'm like, I wouldn't do any of these.
Yeah.
Not that there's not a lot of money made and there's experts that do them. It's just, it's not for me. And this list, like none of these markets. Okay, the two of number 3, markets with little supply but demand headwinds curb rent growth. Yeah, these are all like, a lot of these are, rustier markets that some I've been like curious about, but I've never been convinced that we need to depress go. The closest I've gotten is St. Louis, because there are some submarkets in suburbs outside of St. Louis that are really strong.
Yeah.
But like it has to be, all real estate, you have to be very granular. Some markets more than others. Memphis, I've done a deal in Memphis, didn't have a great experience. I'm just not hot for the market. I'm sure there's a Memphis expert that can just crush it there. Greensboro, same thing. These are all markets that like I have considered and either I've like said no to or just probably not. Like Cleveland, like there are some suburbs in Cleveland I think that could make sense if you know what you're doing, really location specific. But it's just negative population growth.
Yep.
It's just there's not a lot for me to get excited. Baltimore, same thing. Milwaukee, kind of, sort of. I like the idea of Milwaukee more than a lot of the others.
Yeah,
to be honest.
It's a nice city.
Now and then again, this is really where I had this realization, because I'm like, oh yeah, I know like 24 sponsors that this is their list of property, or like pick, like this is your typical stereotypical syndicator markets.
Yeah.
Because everyone's like Sunbelt. Let's go to the Sunbelt. And Dallas, I mean, how many people we know focus on Dallas? Or again, a combination of like 2 to 3 of these markets.
Yeah.
Houston, Vegas, Orlando. These are all markets that like 5 years ago all were projected to be the top rent growth markets, and this is where all the demand. And it's also where the supply ended up all coming, which has brought down rent growth considerably.
Yeah.
This is like similar. The 5 markets where weaker than expected demand has challenged fundamentals. These are just like, I don't know a better way to say it, Matt, but like just like liberal cities, like really strongly Democrat, like Atlanta, LA, Minneapolis, Oakland, Portland, and San Diego.
Yeah, I think that is true. There is that political coincidence.
Does that have nothing to do with it, or do I just make?
Well, I think in terms of like the rent
what
growth
do these have
stories,
in common?
they were never. Atlanta was doing pretty well with rent growth, if I remember.
Yeah.
But for all of these, they were never really top of the charts. They never had like a time where they
Atlanta's
shined.
a little bit of an outlier.
Yeah,
except
I would group.
I think
Atlanta
Fulton County's pretty blue.
Yeah. I think that LA is also its own animal because of just how big it is, and frankly,
these are all
like
markets that have been kind of mismanaged due to local governance.
And Minneapolis, we were talking about Minneapolis and their kind of choking regulation in the name of housing affordability.
It's like just crime.
But Minneapolis had we talked about like their eviction policies but I thought
none of these markets you can evict somebody in.
You cannot.
You
It's
cannot.
harder.
It's
Yeah,
very
yeah.
difficult to evict someone in all these markets. And what do you? There's weaker demand.
Well,
Weaker than
and-
expected demand is challenged fundamentals.
But it could also mean if they're kind of ranking these by performance, maybe cheaper housing in these places. So
Yeah, good luck. And
Yeah.
that's the thing. There's not cheaper housing.
Yeah.
I mean, maybe some parts of Atlanta, but L.A., Minneapolis, there's probably some affordable spots. Oakland, not really. Portland, not
Yeah.
really. San Diego, not really.
Because demand, it's saying weaker than expected demand has challenged fundamentals. It is saying like, well, there's something about it that is not really.
Because everyone's leaving these places.
Could be.
I don't know. Maybe not Atlanta. Not everyone's leaving Atlanta. And then, I'm sorry, we're spending more time on this, but I'm just trying to. I'm playing a game of just what do these all have in common.
Yeah.
And here's another list. I know half a dozen sponsors that this is like their target markets. It's the correlation for the type of market, and it makes sense. But sponsors, you're going after markets with. You have a certain strategy in certain markets, meet that strategy more or less, or the kind of the KPIs, the metrics, the size, the growth rates.
Yep.
They line up, but Austin, Charlotte, Phoenix, Raleigh, Durham, and San Antonio. These were other high flying, well advertised markets to invest in by syndicators in the general multifamily market, and all have incredible long term growth prospects. But as we have just mentioned, there's too much supply.
Are these red state markets outside of maybe Phoenix? I'm not sure.
Austin, it's red state, but I mean,
Blue City, probably. Yeah.
all blue cities. But
What city's not?
they at least have things going on.
Yeah.
Okay, that was the RealPage piece. That was awesome.
Yeah.
All right, where are we going to?
And just
next?
to put a bow on this
Yeah,
RealPage
put a
piece,
really nice
it's
bow on it.
nice. It's nice to have this.
I was told by an attorney today they wouldn't put a bow on it.
Oh, well, I love bows.
He's like, you guys want a bow on this thing, and we're not going to deliver you a bow.
Well.
He's like, it's not going to have a bow on it. It's going to be good, but it's not going to be wrapped in a bow. I'm like, can it be wrapped? Can you wrap it?
Yeah.
It's like when you're checking out around Christmas time at the mall, and they're like, do you want us to gift wrap this? It's like, that's an option.
And then they follow up. Well, it's not going to have a bow on it.
Yeah, and they're like, don't just give me a box. Like,
That's really funny.
or that's like,
they're
fine,
really
I'll take a box. I'll
stretching-
find the bow. That's how we sell the agreement.
We can give you a sticker bow, metaphorical sticker bow, obviously, and legally. But yeah, I think that I like this Carl Whitaker article because it showcases the diverging markets, and there are groups, and they're all are taking different paths, and maybe that's going to continue. That's what I would argue in 2025.